Most traders fail their funded account challenges on purpose and don't even realize it. Look, if you're watching this, you've probably violated a challenge or two. Maybe you're staring at that screen thinking you're just not cut out for this. But here's the truth. Trading is simple. The strategies work, the setups are there, but it's not easy. And that's the whole game. Today, I'm breaking down exactly how to pass these challenges and actually get to payout. We've got advice from prop traders who are consistently cashing out, the 5 habits that separate winners from people stuck buying new evaluations, and the 2 prop firms you should actually be using. Whether this is your first challenge or your 10th, whether you've been funded before and blew it, stick around. This isn't theory. This is how you actually make it happen. And trust me, what I'm sharing at the end could be the one thing that finally breaks you out of the challenge loop for good. Let's get into it. I know you've probably tried a funded challenge before and failed, maybe multiple times. And right now you're thinking these prop firms are designed to make you lose, right? Well, what if I told you that 95% of traders fail funded challenges, not because the firms are rigged, but because they're approaching them completely wrong? Well, I'm about to share the 5 secrets that most traders never discover. These simple truths that, once you understand them, your chances of passing your next funded challenge go up by 95%. Here's the first secret that nobody talks about. Most people who fail funded challenges blame the prop firm. They say things like,
"The firm is hunting my stops,"
or
"They're manipulating the market against me."
But here's the truth. The real enemy isn't the firm. It's what's happening between your ears. Think about it this way. When you're trading with your own $500, you might risk $10 per trade and sleep just fine. But suddenly, when you're trading a $100,000 funded account, that same $10 risk feels massive because you know real money is on the line. Your brain goes into panic mode. This is what I call real money stress syndrome. Your heart starts racing, your palms get sweaty, and you start making emotional decisions instead of logical ones. You either become too conservative and miss good opportunities, or you become reckless trying to make up for lost time. But here's where it gets interesting, and this leads me perfectly to secret number 2, which is going to blow your mind about how to actually start a funded challenge. Secret number 2 is something I call the baby trade strategy. Before you even think about making real trades on your funded account, you need to place one tiny, almost insignificant trade. I'm talking about risking maybe $5 or $10 maximum. Now you might be thinking,
Why would I waste time on such a small trade?
but here's what this baby trade actually does. It's like a test drive before buying a car. You're checking that your lot sizing is correct, that your platform executes properly, and that you can close trades without any weird pop-ups or technical issues. Imagine this scenario. You're confident in your strategy. You place your first real trade risking $200, and suddenly you can't close it because of a platform glitch. Your heart is pounding, you're panicking, and by the time you figure it out, you've lost way more than you planned. That baby trade would have caught this issue when it only cost you $5. But even after you've done your baby trade, there's still one massive mistake that kills most traders' accounts, and it's probably something you're doing right now without even realizing it. Secret number 3 is about something called bias flexibility. Here's what happens to most traders. They do their analysis, they decide the market is going up, they enter a long position, and then the market starts dropping. But instead of admitting they were wrong, they hold on, hoping the market will turn around. This is like being a detective who finds evidence that proves their original theory was wrong. But instead of changing their mind, they ignore the new evidence and stick with their first guess. In trading, this stubborn thinking will destroy your account faster than anything else. The secret is learning to zoom out and reevaluate. When a trade goes against you, don't ask yourself,
How can I make this work?
Instead, ask, what is the market actually telling me right now? Sometimes the best trade is to flip your position completely and go the opposite direction. I know this sounds scary because it feels like admitting defeat. But here's the thing. In funded challenges, being wrong is not the problem. Staying wrong is the problem. The faster you can admit a mistake and adjust, the more profitable you'll become. Now, this next secret is probably the most overlooked opportunity in funded trading, and it's sitting right in front of you, completely free. Secret number 4 is what I call the demo cushion strategy. Most traders think demo accounts are just for practice, but smart traders use them as a secret weapon. Here's how it works. Instead of jumping straight into a paid challenge, you start with the free trial or demo version of the same challenge. You trade it exactly like it's real money, following all the same rules. The goal is to build up a profit cushion, maybe $2,000, $3,000, or even $5,000 in demo profits. Now here's the genius part. Once you've proven you can be profitable in the demo, you convert to the real challenge. But you're not starting from zero anymore. You're starting with a massive head start because you already know your strategy works with these specific rules. It's like practicing a speech in front of a mirror before giving it to a real audience. By the time you're risking real money, you've already rehearsed everything. You know exactly how to hit your profit target because you've literally done it before. This builds two super important things, but I'll let you hear why this is a good idea from one of the top funded traders in the world.
Dan, what is your number one tip to pass a prop firm challenge?
Number one tip is two things. Number one is proof of concept and confidence. Proof of concept is ultimately understanding that the strategy that you have, or the edge that you have, actually works, right? Like, that's so important. You can't go and trade your account with actually the proof of concept. So that comes with back testing, sample testing, understanding your psychology, understanding yourself, and understanding that the whole thing will pan itself out over a period of time. Because if we don't have any of that, no matter what you do, it won't work, right? Because if you don't have a profitable strategy, you can get lucky. You can get lucky once. And this is actually one of the worst things that can happen in trading, is to taste the success. By getting lucky, trading a strategy that doesn't even work, but you just got lucky with those wins, got a payout, and you think it works, and then you spend the next 5 years doing the same shit and not getting results because you don't actually have the proof of concept. So the proof of concept is key over a period of time. So that's number one. Then number two is confidence. And confidence is actually understanding with an unwavering mindset that the work that I put in, the proof of concept and all that work I put in works, and that I have to stick to that. Because it's simple. Everyone who's watching this, or anyone who's traded for a period of time, has gone through a losing streak. Guess what happens in your losing streak? Your confidence goes. What happens in drawdown? Your confidence goes. But the question is, okay, let's take a step back. Why? Like, why is your confidence wavering? Just because there's a negative balance on it, just because you've lost a trade. But isn't that supposed to be part of the process? Isn't that actually part of the proof of concept? Haven't you gone through your back testing and your sample testing and understood that, okay, cool, I can actually have a 6 or 8 trading period losses, that I just have to draw back the risk as soon as I've had 4 or more, right? So then if I have 4 losses, I know that if I do go into this period, I'm going to dynamic risk and take risk off of the table and drop it down, so that if I do go into, or if I do go further into drawdown, the damage is minimal. And then when I call back up and when I'm in break even, then I can put the risk back on and size it back up. So it's incredibly important to have these two things. Number one, the proof of concept, understanding that the edge works over a period of time, that your strategy works, you've got a team and you've got people and you're developing it and you're seeing the proof of it. And then have number two is the confidence to understand that you will be successful and you will fucking win.
Absolutely love that.
This final secret is about a huge change in the industry that most people don't even know about, but it's a complete game changer. Secret number 5 is about timing. And this is huge. The old model of funded challenges used to be brutal. You had 30 days to hit your profit target or you failed. This created a pressure cooker environment where people would take crazy risks just to beat the clock. But here's what's changed. Most major prop firms have completely eliminated those time limits. You now have unlimited time to hit your profit target. Think about what this means. Instead of needing to make $8,000 in 30 days, you can now make $200 per week for 40 weeks if you want. This is like the difference between running a sprint and taking a leisurely walk to the same destination. The sprint might get you there faster, but you're more likely to trip and fall. The steady walk is almost guaranteed to get you there safely. The secret is to completely change your mindset. Instead of asking, how can I make this much money this fast? Start asking, how can I make this much money this consistently? Plan for steady, boring gains instead of trying to hit home runs every day. So there you have it. 5 secrets that transform funded challenges from impossible mountains into manageable hills. Remember, it's not about the firm being against you. It's about managing your mind. Start with baby trades. Stay flexible with your bias. Use demos to build confidence and take advantage of unlimited time. But there's one more thing that stands in the way of you passing your next funded challenge. It's choosing the right prop firm. But which one is the best?
So FTMO is an online prop firm. They started in 2015, so about 9 years ago. They're probably one of the leading prop firms right now. They have great trading conditions, 24-hour customer support, but most importantly, if you follow their rules, they do pay out their traders. So in order to access this account, you're required to pass a challenge that tests your trading skills. You have a 10K account, 25K account, 50K, 100K, and 200K. So usually there's 2 phases for the challenge. You have a phase 1 and a phase 2. So in the first phase of the challenge, you need to achieve a 10% profit. So let's say you went for a 100K account. What this means is you need to achieve $10,000 in profit in order to pass. So just an FYI, a lot of people fail the challenge because they hit the 5% max daily loss. I've certainly done it before, so it's one of those things that you really need to be careful of. I recommend taking the time to read through all of this on the FTMO website. And if you have any questions, definitely use the live chat because the live chat is really good and it's 24/7. So once you pass the phase 1, you will receive an account for the phase 2 of the challenge. And in the phase 2, you still have the 10% maximum loss and 5% max daily loss, but there's a 5% profit target. So you need to make $5,000 to pass phase 2, which is much easier than phase 1. So there's unlimited trading days, so you can take as long as you want for the challenge. So the great thing about FTMO is when you pass and you get your first payout, your challenge fee is actually refunded with the first payout. When you pass a challenge, which I'm sure eventually you'll do, and you get a live funded account, there's no profit target, but there is still the 10% max loss and 5% daily loss.
If this video helped you see funded challenges differently, hit that like button and subscribe. Have you ever wondered if the advice you're following to pass a funded account is actually making things harder? I'm pretty sure a lot of it is, and that's why so many people keep blowing their evaluations. I know, because I did it wrong too. I lost more than a handful of funded attempts before I built a system that works. Since then, 82 traders have used that same framework to secure millions in funding. And today, I'm going to walk you through the exact blueprint to go from zero experience to passing your first funded challenge without the stress, the guesswork, or wasting more cash. Let's make you number 83. But first, I have to tell you something you may not be ready to hear. Do not buy a challenge if you aren't already consistently profitable. I mean it. 3 months of profitable trading on demo or your personal account. Aim for around 10% per month as your benchmark. Why? Because paying for challenges while you're unproven just wastes money and builds terrible habits. If you can't make money with fake money, you definitely can't make money under pressure, especially with some of these prop firms out there, but we'll talk a bit more about that later on. Once you've proven you can be profitable, the next piece is building something repeatable. Next up, you need a system. That's just a repeatable plan with clear entry rules, stop losses, profit targets, and position sizing. Backtest at least 12 months of data. This shows you drawdowns, proves your edge exists, and builds confidence. I'll cover the exact risk management math in step 4, but first you need to know when and what you're trading. Stick around until step 4. I'll show the exact risk math that stops 90% of failures. But why does this matter? Because without a tested system, you're just gambling with someone else's money. Now that you have a proven system, you need to define exactly when and how you'll use it. Now here's the thing. You need to know when, what, and how you'll trade. When? Pick one session. New York or London work best. Stop hopping around 24/7 like a caffeinated squirrel. What? Choose your market. Futures like ES, NQ, oil, or gold. Or stocks. Large caps, sector plays, low-priced momentum names. Pick 2 to 5 instruments and master them. How? Define your entries, exits, stops, and position sizing for each instrument. Quick example. If you trade ES futures, your contract sizing is totally different from a 100-share stock trade. Write both rules down. We'll dive deeper into the exact sizing formulas in step 4. But first, you need to pick the right firm. Let me bottom line this for you. Specificity wins. Vague plans create vague results. With your system and plan locked down, it's time to find the right firm to execute it with. Step 3. This step is arguably the most important. Not all prop firms are created equal. Quick checklist for a good firm. Clear drawdown rules, reasonable profit targets, no crazy time limits, and solid execution. FTMO often makes sense for most traders because they have trader-friendly rules, clear payouts, and scaling options. 75 out of the 82 traders I mentioned got their first payout with FTMO. Choosing the right firm is meaningless if you don't manage risk properly, which brings us to the most critical step. Please listen super carefully during this part. This is the single most important tool if you want to pass a funded account. Prop firms have strict rules for a reason. Daily drawdowns, total drawdowns, limits on contract size. They want to know you're a responsible trader, not someone who's going to full port a single trade and gamble the account away. So how do you handle it? Start by understanding the firm's numbers. If the daily drawdown is 5%, don't treat that like your target. Treat it like a hard ceiling. My rule of thumb, risk no more than half of the daily drawdown in a single day. So if the daily max is 5%, your practical daily risk should be 2.5%. Why half? Because slippage and spreads are real. On prop accounts, the fills and liquidity can differ from your charts. A trade you thought was a 1.5% loss might actually hit 1.75% because the broker's feed is different, or the spread ballooned. That's some insider advice you won't get anywhere else, by the way. Give yourself buffer so a normal market glitch doesn't blow your challenge. Next, plan your trades. Decide how many trades you take on an average day and split the daily risk across them. For example, if your daily risk equals 2.5% and you normally trade 5 times a day, that means 0.5% risk per trade. If you scalp 10 times, your per-trade risk needs to be smaller. This math keeps your sizing logical and prevents emotional oversizing on one big trade. Do not full port to hit a target. If you toss too much risk at one trade and it fails, you're gambling, not trading. The top reason people fail funded accounts is daily drawdown violations. Not even bad strategies. Don't be that person. Finally, treat funded accounts differently from your live account. When it's your own money, you might accept bigger swings. With a prop firm, you must be conservative. Follow the drawdown rules, size per instrument, and keep your trade count planned. Do that, and you massively reduce the chance of a sudden wipeout. Here's the bottom line. You need to know the firm's drawdown limits. Risk half the daily drawdown per day. Divide that across planned trades, and allow for slippage and spread. Stick to that discipline and you'll stop losing accounts for dumb, avoidable reasons. But I really want you to understand this. So here are 2 of the best prop traders in the world to help explain this a bit more.
All right, step 3, risk management. Risk management is probably the biggest and most important tool for you guys to have when you are trying to pass a funded account, okay? This is why. Okay, risk management is the biggest why to pass a funded account, because there's super strict drawdown rules. There's daily drawdown rules, there's total drawdown rules, there's certain amount of contract size or certain lot size that can be risked in a day, certain lot sizes that can be risked at one point in time. Okay, so all of these firms, they have these rules for a reason, because you have to prove that you're a profitable trader, and you know, they have to have these strict rules so that I can't come in there and just full port and then boom, pass the account and then full port again with no drawdown rules. So like, even if price goes down 50%, I can just be like, yep, it's gonna go up eventually, right? That's not gonna happen. The prop firms aren't going to take that risk. So we have to have risk management and we have to understand our risk, okay? And I would like to break down risk management in a couple ways, okay? So this also depends firm to firm, all right? So we're just going to use kind of the basic and overall firm rules, okay? So most prop firms, they give you guys a 5% daily drawdown, like 3 to 5% daily drawdown. That's pretty typical, okay? So with that in mind, how much of a percentage should we be risking per day? If we only have a 3% daily drawdown, the max I would want to be risking per day is 1.5%, okay? And the reason behind this is because, first of all, slippage and spread is a very real thing, and especially on prop firm accounts, a lot of, like, I own a prop firm, so I know how this works, okay? A lot of the liquidity providers that we use, they're dealing with such high volumes that the spread can get fucked up and the slippage can get fucked up, and in turn cause you to, like, when your stop loss gets hit, let's say you calculated it for exactly 1.5% risk on your one trade for the day, you might end up losing 1.75% because of spread, because of slippage, or because simply the ticker symbols are different from the brokerage that the prop firm is using, the liquidity provider, compared to the chart that you're using. So let's say you write down a certain price that you see on TradingView, and that it's not the same, the chart that your brokerage or the prop firm is connected to is giving you a different price. Boom, it fucks your shit up, okay? So I like to risk only half, okay, maximum too, right? Like, we shouldn't be doing any more than that, because if you hit max daily drawdown as a prop firm trader, you just suck at trading, genuinely. Like, you're a gambler, because it's literally saying, look, just don't risk this much in a day. It's not hard. Just take one trade and don't risk this much to prove that you're a profitable trader. We're giving you this super steep, okay, full, like, all-time drawdown, like, of 10% or 12% for some firms, okay? Just don't hit that one. But the daily drawdown is like, You're literally a fucking Hall of Fame crash out if you hit this. And believe it or not, the top reason for why every single person fails a funded account, it's their daily drawdown. It's because you guys are fucking full porting. So this is the most important thing for prop firms to pass the shit. Risk management. Keep your risk management in check. Okay, so the couple things is only risk half of the daily drawdown per day. And that's max. We shouldn't be doing any more. I know a lot of people do 0.5% of the account because they want to make sure that they can take as many trades as possible and just prove like, hey, I'm willing to take a longer time to pass this funded and willing to take more trades for this funded to prove that I'm profitable just to pass it. Okay, so 50% of daily DB draw. Okay, that's horrible. 50% of daily drawdown max, okay?
Please don't try to be smart with your risk management plan. Now, I've seen some videos that other creators have made, and they give you silly little gimmicks around risk management that you might think, oh, wow, that's such a wise idea. For example, one of them that I saw is trade your way to 3% profit by risking 1%. And when you get to 3% profit, risk it all, because if it wins, you'll have passed the challenge. But what if it doesn't, and you end up back to break even? Sure, you'll still break even, you're not in drawdown, but this is massively disheartening, and this is where people's psychology starts to break and they start to make stupid decisions. Because you might think, well, damn, why did I take that trade? I've just thrown away 3%. I should have that back. That's going to lead you to revenge trading. Revenge trading is going to lead you into deeper drawdown. That is going to lead you to more revenge trading. Before you know it, your account is gone. Now, maybe this rule made a slight bit of sense when there were time limits on the challenges, but now there isn't. There is absolutely no excuse to be doing silly things like this. So instead, what I want you to do is choose 0.5% or 1% risk and just stick with that throughout your entire challenge. If you do that, focus on following the previous step of actually just aiming to take the best possible trades, you'll get through in no time, trust me. And guys, I would not recommend risking more, because if you do risk more and it works out, you've gained a good experience from a bad decision. That creates bad habits. Those bad habits will come back to bite you down the line and probably take away one, if not more, of your live accounts. So be patient, be slow, everything will come out in time.
You know what's crazy? Perfect risk management means nothing if your psychology sabotages your execution. Let's fix that next. Don't be greedy. Don't revenge trade. Don't overtrade. If you backtested properly and follow your plan, fear shouldn't drive your decisions. This is my golden rule. Never deviate from your system just because you're bored or frustrated. Your emotions aren't giving you market insights. They're trying to fuck this up. Now here's the final step that separates the winners from everyone else who passes, and then immediately blows up. Here's what separates winners from losers. After you pass a phase, don't immediately trade the next one. Celebrate and step away for a day or week. Why? Because excitement clouds judgment and causes instant blowups. I've seen traders pass phase 1, get pumped, log into phase 2 the same day, and blow it within hours. Don't be that guy. He's dumber than a bag of rocks and is not going to make any money with this thing. I need you to stay until the end because I'm giving you a free screenshot-ready checklist. Here it is. Feel free to screenshot this. You first need to be 3 months profitable on demo, which is very much achievable. Then, 12 months backtest completed and reviewed. Make sure that the strategy you're using actually works. Thirdly, know what you're trading. Make sure it's 1 session, 2 to 5 instruments selected, and rules written. You'd better know those rules. Next, one of the most important steps, choose the right prop firm. Understand those drawdown rules. The most important step, daily risk math calculated. Daily risk divided by trades equals risk per trade. And lastly, plan to rest after passing each phase. You just blew another funded account challenge. And right now, you're probably sitting there questioning everything. Maybe you're thinking about giving up on trading altogether. Trust me, I've been exactly where you are right now, staring at that red screen, feeling like a complete failure. But blowing a funded account doesn't mean you're a bad trader. It doesn't mean you should quit. What it means is that you've just received some of the most expensive education you can get in this business. Today, I'm going to share with you the exact 3-step system I use to bounce back from blown accounts stronger than ever. And I'm going to tell you about a psychological trick that a hedge fund manager who made $10 million in 1 month taught me, something that completely changed how I approach drawdowns and losing periods. But first, let me ask you this. What if I told you that the difference between traders who consistently blow accounts and those who become profitable isn't talent, isn't luck, and isn't even strategy. By the end of this video, you'll understand exactly what separates the winners from the losers in this game. Most traders think they blow accounts because of bad strategy or bad luck. But here's the truth that most people won't tell you. You're blowing accounts because you're fighting the wrong battle. I used to think the same way. I'd blow an account, immediately blame the strategy, switch to something else, and repeat the cycle. See, the real issue isn't your entry or exit points. It's not even your risk management, though that's important. The real issue is that you're treating each trade like it's make or break, instead of understanding that trading is purely a numbers game. Let me break this down for you. If you've done your backtesting properly, and I mean really done it, not just looked at a few charts and called it good, you should know your win rate, your average winner, and your average loser. You should know that over a series of trades, your edge will play out. But here's where most people mess up. They know this in theory, but emotionally, they're still treating each individual trade like their entire career depends on it. That's when the revenge trading starts. That's when you start doubling down on losers. That's when you start taking trades that aren't part of your plan just because you need to get back to break even. I used to do this all the time. I'd have a perfectly good strategy that I'd backtested for months, but the moment I hit 3 losses in a row, I'd start to wonder. I'd start taking trades outside my rules because I was desperate to get that money back immediately. The breakthrough came when I realized that if my strategy truly had an edge, then losing streaks were just part of the process. If I know that over 100 trades I'll be profitable, then what does it matter if I lose the first 10? The math doesn't change. But here's something even more important than understanding the numbers game, and it's something that completely transformed how I handle drawdowns. This is where most traders get it completely wrong. And honestly, this is the part that's going to save your trading career if you really absorb it. I was deep in a trading subreddit a couple of years ago, and I ended up reading about this guy who ran a hedge fund. Successful guy, made serious money. And I learned something that at first sounded absolutely crazy. He said that anytime he had a winning period or a losing period, he forced himself to take 3 weeks off. Complete break. No charts, no analysis, nothing. I thought he was nuts. I mean, this guy had just made 12 million that month and he was taking 3 weeks off. It seemed like the exact opposite of what you should do when things are going well. But then he explained the psychology behind it, and it completely changed how I approach trading. See, whether you're winning or losing, your emotional state gets compromised. When you're losing, your confidence tanks. You become hesitant, you second-guess everything, and you start making decisions from a place of fear. But when you're winning, that's almost worse. You become overconfident, you start thinking you can do no wrong, and you begin taking trades you have no business taking. Both states are toxic to your trading performance. The 3-week break serves as a complete reset. It gives you time to get back to baseline, to approach the markets with no emotional baggage from your recent performance. When you come back, you're not the trader who just lost 5 trades in a row, and you're not the trader who just made a killing last week. You're just a trader with a plan. Now, I know what you're thinking. 3 weeks sounds like forever, especially when you're eager to get back in there and prove yourself. But here's the thing, and this ties directly into what I mentioned earlier about the numbers game. If your strategy truly has an edge, then 3 weeks isn't going to change that. The edge will still be there when you get back. What those 3 weeks will do is clear out all the mental fog, all the emotional residue from your recent performance. You'll come back fresh, focused, and ready to execute your plan without all the psychological noise that was sabotaging you before. But here's some advice from one of the best prop traders on YouTube.
Edge, you understand everything about your trading strategy as a whole, then the point is you don't need to really do anything else. You just need to understand and consider, okay, for me, I know that I've got a 1 to 2. I know that in 5 trades I'll be break even. After a 10 losing streak, 5 trades, I keep dropping the risk. I do all of these things that I understand that I'd have to lose 40 times in a row before I blow the account. So if you can just see the light, see the picture, and make sure that you are focused and understanding that in the long run it will pay out, you will have the confidence, you will have the power and the vision to get yourself out of these moments and times. Because really and truly, if you do the work properly, it is very difficult to constantly blow and blow and blow.
But there's another crucial element to this reset process that most people completely overlook, and it has everything to do with how you approach your comeback. Here's where we separate the amateurs from the professionals. Most people approach their comeback with the exact same mindset that got them into trouble in the first place. They're still thinking about individual trades, still trying to make back what they lost. But professional traders approach it completely differently. They focus on identifying and systematically eliminating the specific behaviors that led to the blow-up in the first place. First, you need to be brutally honest with yourself about what actually happened. And I mean really honest, not the sugar-coated version where you blame the market or bad luck. Were you overtrading? Were you revenge trading? Were you taking trades outside your plan? Were you risking too much per trade? You need to identify the exact behavior that led to the account blowup. Once you've identified the problem, you need to create specific, measurable rules to prevent it from happening again. This isn't about willpower or promising yourself you'll be better. This is about creating systems that make it impossible for you to repeat the same mistakes. For example, if overtrading was the issue, you set a maximum number of trades per day or per week. Let's say 5 trades maximum per week. Once you hit 5, you're done, regardless of what opportunities you think you see. But here's the key, you don't stop there. If you find that even with the 5 trade limit, you're still making impulsive decisions, you add another layer. Maybe you can only trade for 2 hours per day. Now you have 2 constraints working together. If after that you're still having issues, add a third layer. Maybe you only trade 1 currency pair. This reduces the noise, reduces the number of setups you're looking at, and forces you to become an absolute expert on that one pair. You see how this works? Each refinement makes it harder and harder for you to sabotage yourself. You're building a system that protects you from your own worst impulses. This systematic approach is what separates traders who bounce back stronger from those who keep repeating the same mistakes over and over again. But there's one more element to this comeback strategy that could make or break your success, and it's something most people don't even think about. Here's something that doesn't get talked about enough. Not all prop firms are created equal, especially when you're coming back from a blowup. Some firms have rules that are designed to trip you up. Others have inconsistent payouts or change their terms without notice. When you're already dealing with the psychological pressure of a comeback, the last thing you need is to be fighting the firm itself. After going through multiple firms and seeing the differences firsthand, I can tell you that FTMO consistently provides the most straightforward, trader-friendly environment. Their rules are clear, their payouts are consistent, and they don't play games with their traders. When you're rebuilding your confidence after a blowup, you need every advantage you can get. Working with a firm that has your back rather than one that's looking for reasons to fail you can make all the difference in your comeback story. But here's a bit more about FTMO.
So FTMO is an online prop firm. They started in 2015, so about 9 years ago. They're probably one of the leading prop firms right now. They have great trading conditions, 24-hour customer support, but most importantly, if you follow their rules, they do pay out their traders. So in order to access this account, you're required to pass a challenge that tests your trading skills. You have a 10K account, 25K account, 50K, 100K, and 200K. So usually there's 2 phases for the challenge. You have a phase 1 and a phase 2. So in the first phase of the challenge, you need to achieve a 10% profit. So let's say you went for a 100K account. What this means is you need to achieve $10,000 in profit in order to pass. So just an FYI, a lot of people fail the challenge because they hit the 5% max daily loss. I've certainly done it before, so it's one of those things that you really need to be careful of. I recommend taking the time to read through all of this on the FTMO website. And if you have any questions, definitely use the live chat because the live chat is really good and it's 24/7. So once you pass the phase 1, you will receive an account for the phase 2 of the challenge. And in the phase 2, you still have the 10% maximum loss and 5% max daily loss, but there's a 5% profit target. So you need to make $5,000 to pass phase 2, which is much easier than phase 1. So there's unlimited trading days, so you can take as long as you want for the challenge. So the great thing about FTMO is when you pass and you get your first payout, your challenge fee is actually refunded with the first payout. When you pass a challenge, which I'm sure eventually you'll do, and you get a live funded account, there's no profit target, but there is still the 10% max loss and 5% daily loss.
Head to the link in the pinned comment to start with one of their 100K accounts. Now let me tie all of this together with the most important concept in trading. Thinking long term. If you've done your homework, if you've backtested your strategy properly and you know you have a genuine edge, then individual losses are just noise. They're part of the process, not the end of the story. I know traders who have to lose 40 trades in a row before they blow their account. Think about that for a second. The probability of losing 40 trades in a row with a decent strategy is so small, it's essentially impossible. But here's what happens to most traders. They lose 3 or 4 in a row and they panic. They start questioning their strategy, changing their approach, or worse, they start revenge trading to try to get back to break even immediately. This is where the long-term perspective comes into play. If you know that over 100 trades you'll be profitable, then what does it matter if you start with 5 losses? The math doesn't change. Your edge doesn't disappear because of a few bad trades. So here's your action plan. First, take that break. I don't care how eager you are to get back in there. Take at least a week, preferably 2 or 3. Use that time to honestly analyze what went wrong and create specific rules to prevent it from happening again. Second, when you come back, Start small. Your ego might want to jump right back in with full size, but your account balance and your psychological well-being will thank you for starting conservatively. Third, focus on execution, not results. Judge yourself on whether you followed your rules, not on whether individual trades were winners or losers. And finally, remember that this is a long-term game. The traders who succeed aren't the ones who never have losing streaks. They're the ones who handle losing streaks professionally and stick to their plan. Blowing a funded account isn't fun. I've been there 3 times, and it's one of the most frustrating experiences in trading, but it doesn't have to be the end of your story. Some of the most successful traders I know have blown multiple accounts before finding their groove. The difference is that they learned from each failure, refined their approach, and came back stronger. They understood that trading is a skill that takes time to develop, and setbacks are just part of the learning process. 8 years ago, I discovered a secret. The key to becoming a profitable trader isn't about using fancy trading strategies or risking half your account on a can't-miss opportunity. It's actually about forming micro-habits, tiny habits that you follow consistently. These small trading habits completely transformed my results. I went from blowing up 3 accounts to generating consistent profits month after month. Today, I'm going to share the 5 tiny habits that made the biggest difference in my trading, and also share tips on how you can apply them to your own trading as well. Let's dive in. The first habit sounds deceptively simple: sitting on your hands. Trading without patience is like performing surgery after watching a YouTube video. It's dangerous and expensive. My most profitable days often involve doing almost nothing. I'm not constantly entering and exiting positions. I'm waiting, sometimes for hours, for setups that perfectly match my criteria. Here's what most beginners get wrong. They confuse activity with productivity. They think more trades equal more profit. But the market doesn't reward action. It rewards correct action at the right time. That pit in your stomach when you feel like you need to be in a trade, that's usually your first sign you're about to break your rules. I notice many of you jumping into trades just because the market is moving, but volatility without a proper setup is just noise. I prefer predictable, average market movements where my edge is clearly defined. Remember, patience isn't just the ability to wait, it's how you behave while you're waiting. Ask yourself, am I analyzing, learning, and preparing? Or are you just itching to click that buy button? The second habit that transformed my trading was following the exact same process for almost a decade straight. Your trading plan isn't just a good idea. Think of it as your survival kit in the market jungle. And consistency is the key to making it work. When you tell me you're trading without a written plan, what you're really saying is you're gambling, not trading. Every morning, I go through the same routine. I check the same key levels, I look for the same patterns I apply, the same risk parameters, I journal the same metrics. I don't stray to the left or to the right. And nothing changes just because yesterday was a winning or losing day. Nothing changes because I read about some hot new strategy online. That complex strategy with 15 indicators, it's probably making your decisions slower and less accurate. Let's simplify. The pros aren't constantly searching for new tools. They're mastering the execution of simple, proven processes. Your trading platform should be boring most of the time. Constant action is a warning sign, not a badge of honor. My third habit might be my true superpower, and it's the ability to pass on trades. The pros aren't focused on making money. They're obsessed with not losing it. That's the mindset shift you need. That 1% risk per trade feels restrictive until you realize it's what keeps you in the game during losing streaks. But here's what separates consistently profitable traders from the rest. They don't just manage risk on the trades they take. They avoid unnecessary risk by passing on suboptimal setups. FOMO isn't just costing you money. It's hijacking your decision-making process entirely. I'd rather miss 100 potential winners than take one trade that doesn't meet my criteria. Why? Because my edge isn't in individual trades. It's in the consistent application of my system across hundreds of trades. So, don't think you're going to become rich with one trade. That's not how this works. It's over hundreds of trades over a long period of time. Also, stop losses aren't optional safety features. They're the seatbelts that keep you from getting ejected from the market. Are you making trading decisions based on research and your written plan? Or are you just following social media tips? Without the discipline to pass on trades, you're constantly exposing yourself to unnecessary risk. And that leads us perfectly to our next habit, which addresses the psychological root of overtrading. The fourth habit that changed everything was developing a scarcity-free mindset. What does that actually mean, though? The market doesn't owe you quick returns just because you need them. One of the most expensive lessons I learned was that there is no last chance to catch a move. The market will always offer new opportunities tomorrow, next week, next month. Trading with a scarcity mindset, thinking, I have to catch this move or I'll miss out forever, is a guaranteed path to account destruction. I used to overtrade constantly. Let me show you how I broke that expensive habit. I started trusting that better setups will come if I just wait. The market has existed for centuries and will continue to provide opportunities every single day. So your expectations of making 20% daily returns aren't just unrealistic. They're the exact mindset that leads to over-leveraging. The path to consistent profits looks more like a monthly salary than a lottery win. The final habit is developing immunity to FOMO, or the fear of missing out. That urge to always be in a trade, it's your account's silent killer. I see people make this mistake over and over, and I guarantee it's what's slowing down your progress. The hardest skill in trading isn't finding opportunities. It's having the discipline to wait for the right ones. The market doesn't care about your mortgage payment or your need to recover yesterday's losses. When I see a massive volatile spike that doesn't match my setup criteria, I don't jump in out of fear of missing the move. I observe, I learn, and I wait for my edge to return. Your emotions are trying to hijack your trading plan. Every time you break your rules because this time feels different, you're letting your limbic system override years of market knowledge. Trading without emotional control is like driving blindfolded. You might get lucky for a while, but eventually you'll crash. Remember, professional traders aren't trying to double their account each month. They're building sustainable processes that work across different market conditions. So there you have it, 5 tiny habits that completely transformed my trading. You should definitely try working on these habits in your own trading. Now, if you're struggling to implement these habits, you're probably making some of the common mistakes covered in my previous video. I break down exactly how to identify and fix these critical errors. If you found value in this video, hit that like button and subscribe for more content like this.